So on the bright side, we only dropped 880 points today, the Dow Jones, while yesterday we dropped 1,000 points. I think that's the only bright side. S&P 500 dropped 97 points, 3%. 3% is a lot. So yesterday 3%, today 3%. That's 6%. We're almost close to a 10% drop in the general market. Not only that, but if you look at the SPY 5 days ago, it was trading at, here, this is the SPX or the S&P 500. Let me just look up the SPY. It was trading at 338. Right now we're at 312 in less than 4 days. That's just scary. So I want to talk about the trades I made today and the trades that I plan on making. Although there really isn't something that's crash proof, but I think this is the best I can come up with. Let's look at the other stuff here. I mean, look at the Qs, the ETF that tracks the NASDAQ, 215. I bought this last week at 234. Just a few days ago, I bought it 234 and 100 shares of it. I don't know why I just didn't wait 1 week. I would have bought it at a much better price this week. While everything was down today, you've got a few stocks that were up today. HP, Teva Pharmaceuticals, Canon, Roku was up 1.44%, Domino's Pizza, Zoom Video. I think at some point McDonald's was up, but closed the day in the red. But yeah, besides that, everything else is down. American Airlines 9%. That's really scary. $23. I have it in my margin account at 31. MasterCard took a big drop. I think this would be a good time to get into MasterCard. I love MasterCard. 6.71% today. Trading at 302. I've got a put spread on MasterCard here. Let me show you. If I go to my margin account, I've got a put spread on MasterCard with a short strike of 325. Expiring March 20th. So I need MasterCard to trade above 325 come March 20th or I lose quite a bit of money. I still have time. I've got 24 days to go, but who knows how long this market correction is going to last. Uber's down, Delta Airlines, Western Digital. I used to do covered calls on Western Digital. FedEx is down 6% almost. And my margin account, look at my margin account. My equity is negative now, 4,900 negative equity. Last week, my equity was 4,100, even 4,600 at some point. Now I've got a negative equity of 4,900. That's because a lot of my positions right now are down a lot. I don't even have enough buying power in my margin. I'm actually leveraging my TFSA. So most of my buying power in my margin comes from my TFSA. So American Airlines, I'm down $500 on the stock itself. Box, I'm down $1,000. Dell, I'm down $660. MasterCard is a put credit spread, so I'm not down until the trade is over, which is March 20th. But right now, as we stand, I'm down about 5,000 minus 427. I'm down about $750 on MasterCard. Now I've got a bunch of put spreads on the SPY. So this is the main trade that I'm playing right now when the market is dropping. Today I sold 2 put spreads on the SPY. So one expiring March 31st at a 300 strike and the other one expiring April 1st at a 295 strike. Collected 78 cents each time. So right now if you look at the SPY, so right now the SPY is at 312. I've got a short strike at 300 and 295. What was it again? Yeah, 300 and 295 by end of March or April 1st. So the SPY already dropped from 338 to 312. I said this yesterday and I'm going to have to say it again, although I feel bad saying it, but what are the chances that it keeps dropping more, making my 300 strike and 295 strike a bit safer 30 days from today. So I think it has a good chance of winning. I also had another one, an open order that didn't get filled because it almost got filled. I had one expiring April 3rd, but I was going at a 290 strike. When the SPY was trading at around 311, I had an order for a 290 strike on the put, selling the 290, buying the 285 put for April 3rd, but it didn't get filled. I was asking for 80 cents and it got, I think 78 cents would have gotten executed, but I just left it at 80 cents. I didn't know how far the market would drop, but I'm willing to sell it tomorrow if the market keeps dropping. If it drops below 310, I'm gonna sell another one. It's a little scary because I feel like I'm compounding losses, but in my opinion, I find it's the best way to mitigate these drops. So right now I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 put spreads on the SPY. They each have their own strikes. Some of them are safer than others, of course. So the 328, the strike of 328 is not safe at all, of course. I do have time. I've got until March 13, March 16, March 20th, but I don't know if the market is going to continue to drop or if it's going to start rallying. Normally, it would start rallying. I mean, if you look, this is a bit similar to December 2018, because in December 2018, the VIX was, the VIX reached 30, and right now we're at 28, I think. Yeah, the VIX is at 28 right now, but if we look at the VIX in December 2018, so VIX, you could see here, December 17, 2018, VIX was at 30.11. Right now we're at 28. So it's a bit similar to what happened in December. Now, if we go look at the SPY in December, if I was selling put spreads on the SPY in December 2018, let's see what would have happened. All right, so I'm looking right now at the SPY, December 18. Let's look at a 1 month period. Actually, so let me look 1 month and then go to December 2018. All right, where's December? All right, so it starts about here. So this is a 1 month period that we're looking at. You could see it, December 3rd, SPY was at 279. Let's say I would have sold a put spread then. Probably would have sold it at around maybe a short strike of what, 260 maybe? 260, 255. And 30 days later, you could see that it was trading at right almost at 255. But maybe I would have been able to close it somewhere in the middle. But definitely I would have sold another one here, December 7th. I would have sold another one Monday, Wednesday, Friday, or every day if I can. I would sell another put spread. Always a little bit lower. So even if the first one here loses, the next ones have a better chance of winning. And if we just move a little bit, you could see that, yeah, all this would have won. Even the first one here would have won. And of course, the worst part here, December 24th, if I had sold one on December 24th, I definitely would have won, because the market just went back up after that. So you could see that. Let's go back. I really want to show you this carefully. Let's start from December 1st, all right? So right here, December 1st. If I sell a put spread every day or every 2 days, okay, 30 days out, and I always go a little bit lower. I don't go where the current market price is. So if the current market price right now is 279, I'm going to sell a put spread at around 265 maybe, 30 days to go. So if I do that and then time goes by, you can see it's actually going down, so that's not good for me. It's getting close to my short strike. It passed my short strike of 255. And honestly, I have no way of recovering. So that one would have been a loser unless I rolled it forward, gave it more time to be right, and I sold a call spread against it to increase or to reduce my max loss. But as this one is losing, the next day, I'm going to sell another one. SPY is trading at 270 in this case. I'm going to sell at 255. So time goes by, we're at 264, 265, 260. Who knows, maybe when we were at 265 with 10 days passing, maybe I would have been able to close the spread for 50% profit. But let's say I wasn't able to. Time goes by, I'm losing. It really went below my short strike of 255. But I still have 30 days, so I'm going to hold on to it. And then slowly it comes back up and it gets close to my 255 strike, but not enough. So I don't lose max loss, I lose a little bit less. And maybe I can reduce max loss by selling a call spread against it, or even rolling the spread forward. And then the next day, guess what? I'm going to sell another one. SPY is at 270. Going to do the same thing. I'm going to sell at 255. 30 days later, the SPY is at 254. But when the SPY was at 270, I probably could have closed it around here. If not, obviously it keeps dropping. I'm not going to be able to close it, but it comes back up and it gets really close to my 255 strike. So even if I hold it till expiration at 254.38, I'm actually going to break even at this price. I'm not going to lose money depending on how much I collected, but usually I'd be collecting about 60 cents. If my short strike is 255, then the SPY closes at 254.38, then I'm going to end up paying 60 cents to close the trade. So this trade would have been break even if I had done absolutely nothing. But usually I'm going to try to do something to manage it. But guess what? The next day comes along. I'm going to sell another put spread. The SPY is at 264 now. I'm going to probably go to 250 short strike. And you could see that 30 days later it's at 257. So this one would have been a winner if I hold it till expiration, but I probably could have closed it for 50% if I had the chance before. Another day goes by, the SPY is at 264. I'm going to sell a put spread at maybe around 250 again. 30 days later, the SPY is at 258. So this one would have been a winner. That's if I don't close it at 50% before. A few days go by, I sell another one. SPY is at 265. I'm going to sell at 250 again. 30 days later, the SPY is at 258. So that one would have been a winner. So in my opinion, what I'm noticing is when the market is dropping and I keep selling out of the money put spreads on the SPY, every new put spread that I sell has a better chance of winning because it has 30 extra days and it's even further out from the current market price, and I'm collecting a bit more premium because volatility is high, and because volatility is high, I'm able to go further out. So it's a combination of many factors that make my new put spread, it gives my new put spread a higher probability of winning. So right now this is sort of where I am. I really just hope this doesn't backfire. This would backfire if the SPY just continues to drop, of course, and takes maybe 2 or 3 months before it starts to recover. But if this is just a slight correction like we saw in December 2018, then this could work. I might have to roll forward a few put spreads if I can. I'm going to try because, for example, this one here, if I had sold a put spread here, December 3rd, 2018, while it was trading at 279, I would have sold maybe at 265. But you could see that 30 days later, it's trading at 244. So I would have lost definitely on that one. But maybe if I had extended the trade, remember I need to be above 265. If I had just given the trade maybe an extra 15 days or even an extra 30 days, you could see that it's at 271. So by rolling forward the put spread, I give it a chance to win. So that's probably what I'm going to try to do with these put spreads if they backfire. I've already got I've got one at 328, 328, 326, 325, 320. So I've got 1, 2, 3, 4, 5 that are in trouble. Actually, 6 are in trouble. I've got 6 that are in trouble right now because the SPY is trading below the short strike. But I still have time on them, so I'm not going to take action right away. I took action on one of them today, which is this one here, the March 13, because it's the closest one. I've got 17 days to go. And the action I took was I sold a call spread at the same strike of the short put. So I sold a call spread at a 328 strike. I sold a call at 328 and bought the 333. So the same risk, a $5 wide spread. So now first of all, by selling this call, if the SPY continues to drop, well, instead of losing max loss, I reduce max loss because I just collected a credit from the call side that I'm gonna keep. At the same time, if the market decides to rebound, I can close a trade once the SPY reaches 328, maybe, depending on how much time is left on the trade. If SPY closes March 13 at exactly 328, I'm going to make max profit, which is going to be the premium that I collected by selling the put and the premium that I collected by selling the call. But that's if at exactly expiration, SPY is at 328. But the closer it gets to 328 and the closer we get to expiration, I can probably close it for a profit or even break even or for a small loss. If I can close it for a small loss, I'll accept. But that's how I'm managing this one here for now because it's the closest one till expiration. I've got 17 days only. The other thing I could do is maybe after a week, I have to be careful not to get assigned on the put spread. So I've got a short 328. There's a risk that I can get assigned 100 shares of the put at 328. In fact, it's going to be 300 shares. And of course, I don't even have the buying power for 300 shares. So that's going to be a big problem. So I don't want to get assigned 300 shares. So I have to be careful that there's still time value left in the put option. So that means the buyer of the put option, if there's no more time value left in the put option, if there's only intrinsic value, the buyer of the put option, we have to assume that the buyer of the put option probably owns 100 shares of the SPY, probably higher than 328, and they bought the put option to protect themselves in order to be able to sell their stock at 328 in case it drops. So for someone to exercise their put option, it's because they want to sell their holding at 328. They want to sell their stock at 328. But if they have the put option and it still has extrinsic value, they're better off selling the put option and then selling their stock at the same time. They'll get an extra premium by selling their put option if it has extrinsic value. But if it doesn't have extrinsic value, then there's a chance that it gets exercised, and I'm going to end up with 300 shares of the SPY at a 328 price, which of course is not something I want. It's not even something I can afford. So right now the put option has a value of 1650. Oh yeah, right now the put option has a value of about 16, and this is the 328 strike, and the SPY right now is trading at 313. So here's how I'm calculating the extrinsic value. So 328 minus 313 is 15, but the put option is trading for 15.5 to 15.97. So there's about at least 58 cents of extrinsic value in this put option. So the owner of the put option is better off selling the put option on the market to get that extra 58 cents, plus selling their shares at whatever price the SPY is trading at, which is 313. By doing that, the owner of the put option gets an extra 58 cents of profit instead of exercising their put option. If they exercise the put option, they're only going to get 328 for their shares. But by selling the put option, they're getting $15, they're getting 58 cents, and they're getting the 313. So they're getting more than 328. They're going to get 328.5 if they sell the put option directly on the market instead of exercising it. But I have to be careful with this because the closer it gets to zero, so if there's no extrinsic value left in the put option, in the short put option, then there's a chance that my short put gets assigned and I end up with 300 shares of the SPY at 328. So what I could do to avoid it is roll the put spread forward. So how would I roll the put spread forward? So first of all, I would remove the call. I would have to buy back this spread for a loss, of course, but then I'm going to sell the same strikes but further out. So for example, this is March 13. Let's say I go to April 17. I would sell the 328 put, and then I would buy back the 323 put, same expiration, April 17. So 323 I said. Obviously same number of contracts, so 3. So I'm closing this one for a loss, but I'm selling a brand new one at the same strikes. I'm basically rolling it forward. I'm basically adding time to the trade to give it a chance to win. But I need to do that for a credit. I'm not going to do that for a debit. So just doing that alone, as you could see, it's going to be for a debit. I'm going to have to pay about 60 cents per contract to roll that to give it more time. But I don't want to do it for a debit because then I could be compounding my losses because I don't know how much time I'm going to keep adding to the trade every time. So what I could do to make sure I can roll this for a credit, add a call spread to it. So right now, by closing the existing put and rolling it forward, I'm going to pay about 60 cents. So remember, 60 cents. Now to get a credit out of it, I can try to sell a call spread also at the same expiration of April. So I'm going to go call. I'm going to go April 17, and the strike I'm going to choose is going to be either 328, so the same strike as the put, or higher. But let's see what happens if I go for the same strike as the put, so 328 and then 333. So if I remove the puts just to see what I'm getting, so I'd be getting $1.35 by selling the call spread at the same strike. So this way I'd be able to roll the trade forward for a credit, because remember, just by taking care of the put side, I'm going to have to pay 60 cents. By adding the call spread, also the same expiration of April 17, I'm getting $1.35 credit, so it's going to give me a net credit of about 70 cents. So what that does is that it gives me time for the market to come back up. I'm not looking for profit anymore. Now I'm just looking to reduce max loss, because max loss is pretty big. When I opened the trade, I think I collected 50 or 60 cents, so max loss is $4.40 times the number of contracts. So right now I'm just trying to break even in the trade by rolling it forward and just waiting for the market to come back up to my short strike. So if I do that, I now have until April 17. So I'm giving myself 47 days. Now, of course, I'm not going to do that now. I'm going to wait until there's no more extrinsic value in the option, the short put option. But what I would do is move it forward to April 17, give myself more time for the SPY to reach 328, and I'll just close it for break even. I'm not going for a profit as soon as the SPY reaches 328. If it reaches it, the problem is if it reaches 328 way earlier than April 17, then it's going to be hard to close it for a decent price. But if it reaches 328 and there's a few days left to April 17, then I have a better chance of closing it for break even or even for profit. But that's the idea behind all this, is just to give myself more time to win and just to avoid max loss. And I just keep moving the trade forward for a credit always. If the SPY continues to drop, well, it doesn't cost me anything because I just collected a credit by moving this trade forward, and then I could once again move it again forward, making sure I collect the credit by rolling it forward. So that's what I did today with the SPYs here. I only managed one of them because I felt like it only had 17 days to go. SPYs at 313. I don't think it's gonna reach 328 in 2 weeks. It's possible. I mean, I've seen it, but I think it's gonna take some time before it reaches 328 now. More than 17 days. That's just my assumption. I do think the market's gonna come back up. That's just my opinion as well, but I don't think 17 days is enough for the SPY to reach 328. And even if it does, it's going to be good for me because I collected a credit from the call side. I might even close the whole trade for a profit, so I'm good with that. Now I just have to be careful with the other ones as well, and I have to make sure that there's still extrinsic value left in the put option so that I don't get assigned. And I'm going to continue selling put spreads on the SPY if it continues to drop hard. So the last put spread I sold on the SPY was this one here, April 1st, 295 short strike. I think the SPY was trading at around 313 when I sold this one, but I'm going to sell another one if the SPY drops below 310. I'm not going to sell another SPY put spread if the SPY is trading at the same price. I'm going to wait until there's a bigger move for me to sell another one so that the new put spread has a better chance of winning. Remember, I have a cover call trade on the Qs, so that really killed me. 233.88 is my cost. Right now it's trading at 215. I'm down 1800 US. That really hurts. But my call option that I sold at a 232 strike expiring March 6th is really profitable. I can close it, confirm the profit, and sell another one. I was thinking of selling another one this week, February 28th, at the same strike, but I didn't want to manage too many things. I wanted to focus on my put spreads, which is more dangerous. And same thing on IWM. The call option that I sold for 77 cents yesterday, it's already worth 8 cents. It's already $69 profit. I can bring the call option lower, the strike lower, keeping the same expiry, collect the credit, but who knows? IWM can recover and trade above my strike, and I don't want that. And it was going to be for an extra $30, so I didn't think it was worth the management. These are the two positions, besides my margin account, these are the two positions that I'm watching carefully. The other problem is, though, I'm running out of maintenance excess. So maintenance excess is basically my buying power in this case, which comes from my TFSA. So as my TFSA goes down because my positions are going down, my buying power in my margin account goes down. And if my buying power in my margin account goes down, I'm unable to sell put credit spreads on the SPY as the SPY goes down. So it's a little problematic. I might run out of capital if the market really continues to drop this way and for 6 months straight. So if it drops like this for 6 months, I'm in trouble. But if it's just I think my max time frame is a month. If it goes past a month, I'm in big trouble. But if it's 1 month, I think I can recover. I did have a good trade, the earnings trade on Home Depot, but I'll leave that for a separate video. All right, let me know what kind of trades you guys made today while the market was dropping. Leave them in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.